Edelweiss Financial Services. You've got Chowdhury, Managing Director, Equity Research with Global Equities Research. Gentlemen, good morning to both of you. Thank you for joining us. Sandeep, what we've seen this year is a classic mean reversion. Big spike in IT stocks, P multiples went through the roof. Now they've almost come back to pre-COVID levels. Where will things settle for IT, Sandeep?
Thank you for being me on the show. I will just say this: I have seen this peculiar thing which you're talking about at least 4 times in last 20 years. After 2002 tech bubble burst, the stocks went through the roof, and then they collapsed by 20, 30, 40%, and it was looking like the same situation we are in today. Same thing I saw after 2011, after GFC, when stocks went up, because initially Infosys started with giving a negative growth guidance, and then they ended up in a deep positive growth for the year, and the stocks all went up like anything mad. And then, we saw a correction for 6 to 8 months of 30, 40%. Then again, things started moving. So this is not new. My only point and my only argument to this is that, what today investors are building in and what many people are building in is a impossible equation actually to happen. On one side, you are saying that, there is a recession and there will be a hard landing of recession in the United States, and that will lead to collapse in demand. And on the other side, people are saying that, because attrition is high, the margins will also remain challenging. Now, both the things cannot be true, right? The demand is there, the attrition is high because there is high demand. And if demand falls, then attrition has to fall. I will just give you one data point, Q3 FY21, and it is not right now on the screen, but I can, share that with you. You just see Q3 FY21 data for all the IT companies. The attrition made a bottom and the margins made a top. And in last 6 quarters, we lost all the margins, and our attrition is up more than 100% on that base. So, for example, TCS was 7.2% attrition. Today it is 19.6%, and margins were 29.1%, and now it is at around 24-25%. So definitely now attrition is pulling off in a big way because startup is no more taking people. Fangs has also pulled off taking people. And so once attrition starts coming down, you will see a much better margin and EPS upgrade again from September quarter. That is what my call is.
Chowdhury, Sandeep is making a very interesting point that one side markets are nervous about attrition, and on the other side there is a demand concern which is coming back. What is the right story? Because you cannot see the candle burning from both the ends. Either it has to be in demand challenge or it has to be in supply constraint. What is the real picture according to you, Trip?
I think we have to see the Indian IT sector from a new set of lenses and new set of glasses. First and foremost, the Indian currency is very weak against multiple Western currencies. That is a holy grail for Indian IT services company. The services that Indian companies are providing are being very cost effective. That is a key driver for demand. Second, as Sandeep mentioned, there have been some people who have been going to startups. But remember, in USA also there are a lot of startups. Startups hire engineers who don't have software engineering discipline. It is only Indian IT services companies like TCS, Infosys, Wipro, who have real software engineering skills, not writing spaghetti code, but writing really professional enterprise-grade source code. These are the key reasons why, moving forward, all Indian IT services are going to do very, very well because two things. Demand is there, and the demand for the skill sets that only IT services in India have, and weakening of rupee are all the catalysts that make investing in Indian IT services company a very good investment.
Okay, so you think investing in Indian IT companies is still a very good investment, but taking forward for that, I'd like to ask you a follow-up question, and that is where, with the large caps, where it might be safer, with the mid-cap IT companies, where, let's face it, we had seen valuations really get overstretched.
I think the large companies will do well because if you think about the small companies, they are just providing point solutions. What the customer is asking is, please take my problem, provide me with the solution. Don't give me piecemeal answers. So I don't think from a long-term perspective, small and mid-sized IT services will do well. I think this is a time when Infosys, Wipro, TCS, they should go and capture the market share. They should change the customer narrative. They should not go under the covers and hide. This is an opportunity for them to exploit. The market is moving in their direction, and they should really take advantage of that. So I think large companies will do well because of its scale, because of its geographical presence, because of their multiple points of delivering IT services to the global customers. These are very strategic and in high demand as the world goes through this downturn, and India and Indian IT services company will come up with flying colors.
Sandeep, would that be your strategy as well? Stay safe with the TCS, with the Wipro, Infosys. Now in HCL Tech, which is the country's third largest IT company, that's better than the mid-tier, the smaller IT services companies?
So I will tell you the story which will happen in next 3 to 4 months. And when I come back on the show, you will recall what I'm saying today. Till now, till last quarter, people were fearing guidance cut and everything. But the fact of the matter is that, Accenture and Infosys both upgraded guidance. Let's deal with data, and rest everything is story. Now the new problem which Street is saying is that, demand will collapse and attrition will remain high and margins will not recover. I'm telling you on the show that in 6 months, you will see massive recovery in margins because attrition can't stay at this level. And then revenue growth has to go up substantially from here if attrition is here. Attrition for the industry is always a lead indicator of very good demand. Now coming to what to buy and what not to buy, I will say that, because in next 3 to 4 months, you will see a situation where margins will recover, but, management commentary will become little bearish from here on the growth side because they don't want to do chest thumping. That has been the pedigree of all Indian IT companies. They don't do chest thumping. They don't talk very optimistically. They are always talking very conservatively. So, there'll be a situation where you can see time correction in the stocks. So as the previous panelist said, I would reiterate that, right now is the time to be in safe waters. So be with large cap for some time, and then in say 3 to 4 months, once the tide turns, then you can again go back and chase growth like with the good mid cap companies like LTI, Mindtree and all. I'm not saying to sell anything. I'm reasonably confident that, we are almost in terms of price, we are at bottom of the price for the companies, for most of the companies. But we can see a time correction of 3-4 months, and then it will bounce back very strongly. I am seeing this is 22nd year of doing same work. And I can tell you, I have seen 4 such cycles in the past. You can have challenges for 3 to 4 months, 6 months. It is a sentimental challenge and no fundamental challenge at all. So we have to deal with it. So be with large caps and primarily with where you have very good support of dividend yields. Like, HCL Tech today is maybe on forward basis, it is 5-6% dividend yields. You can't lose anything from here.
Right. Okay. Sandeep, Trip, both of you, thank you so much. Who better than both of you to really analyze the construct of the IT sector right now? Good speaking with you as always.